You're 40. You've finally got some money moving into an account every month. And now you're staring at two buttons. Button 1 says aggressive growth. Button 2 says safe and steady. Your finger is hovering, and whichever one you pick feels like it's going to decide whether you retire comfortable or retire scared. Here's what most people believe at this point. Safe is smart. You're not 25 anymore. You can't afford to gamble, so you dial down the risk, you protect what little you've built, and you sleep better at night. That feels responsible. It feels like the adult decision. Here's the problem. For most people starting at 40, safe is actually the riskier choice. Not emotionally risky, mathematically risky. Playing it safe at 40 is often the single decision that guarantees you stay behind for the next 25 years. And I want to be clear about something before we go further. This isn't a video telling you to gamble your retirement on meme stocks or crypto, or whatever your coworker mentioned at lunch. Aggressive, in the way we're using it today, has a very specific, very boring, very well-documented meaning. It means owning a broad mix of company stocks through simple index funds and giving that mix enough time to do what it has reliably done over every extended period in modern market history. Boring and aggressive are not opposites here. They're the same thing, and I can prove it with one number. A 40-year-old who goes conservative and earns roughly 4% a year needs to save nearly double what an aggressive investor needs to save just to land in the same place at 65. Double. Same goal, same age, wildly different price tag depending on which button you press. So let's actually work through this, because aggressive or safe isn't a vibe, it's math. And today we're doing the math. First, let's define our terms, because these words get thrown around loosely, and that's part of the problem. Aggressive, in this context, means a portfolio that's heavily or entirely in stocks. Think a total market index fund, or a mix of large and small company funds. Historically, a portfolio like that has returned somewhere around 9 to 10% a year before inflation, averaged over long stretches of time. Not every year. Some years it's up 25%, some years it's down 20%. But averaged over decades, that's the range. Safe in this context usually means bonds, CDs, high-yield savings, or a heavily bond-weighted portfolio. That kind of mix has historically returned somewhere around 3 to 5% a year. Much smoother ride, much lower ceiling. Now here's the part almost nobody explains clearly. At 40, your money has roughly 25 years to grow before you touch it for retirement. 25 years is not a short runway. It's long enough to ride out multiple market crashes and still come out ahead. The entire argument for going safe is built on a fear that makes sense at 65, not at 40. And that timeline isn't theoretical. Look at what actually happened. The dot-com crash in 2000 wiped out roughly half the market's value over 2 years, and it took until around 2007 for the market to fully recover. The 2008 financial crisis cut the market nearly in half again, and it took about 4 years to climb back to its previous high. The 2020 crash was faster and sharper, a 30+% drop in weeks, and the recovery took only about 5 months. 3 very different crashes, 3 very different recovery timelines. But here's the pattern that matters. In every single one of those cases, someone who was 40 years old when the crash hit, and who stayed invested instead of pulling out, was fully recovered and well ahead within their remaining runway to 65. The people who got hurt permanently weren't the ones who owned stocks. They were the ones who owned stocks and then sold at the bottom out of fear. Let's meet Marcus, late 40s, self-employed, income that goes up and down depending on the month. Marcus has $40,000 saved, and he's putting in $800 a month. When Marcus first started investing, his instinct was to play it safe, a mix of bonds and cash, because his income already felt unpredictable, and he didn't want his investments to feel unpredictable too. That's a completely understandable instinct. It's also, mathematically, the expensive one. If Marcus keeps that conservative mix and earns around 4% a year, by 65, that $40,000 plus his monthly contributions grows to roughly $410,000. If Marcus instead goes aggressive, mostly stock index funds, and earns closer to 9% a year, that same starting point and same monthly contribution grows to roughly $890,000. Same guy, same discipline, same monthly amount going in. More than double the outcome, purely because of where the money was invested. That gap, over $480,000, isn't from Marcus saving harder. It's entirely from the growth rate. Here's a checkpoint worth sitting with. If Marcus checks his aggressive portfolio 10 years from now, at 57, it won't have grown smoothly. There will be a year where the balance actually looks lower than it did 12 months earlier. That's not the plan failing. That's the plan working exactly as designed, because Marcus still has 8 years left before he needs $1 of it. The mistake would be checking that dip and deciding to move everything into cash to protect what's left. Because that single decision, made out of fear at the wrong moment, is what turns a temporary dip into Marcus's permanent, locked-in loss. Now, if you're already thinking, okay, but the aggressive portfolio also means bigger crashes, bigger stress, bigger risk of losing it all right before retirement, hold that thought, because that concern is real, and we're going to deal with it directly. It's not wrong, it's just not the whole picture, and it's not a reason to default to safe starting today. Let's meet Sarah. Early 40s, rebuilding after a divorce, starting her retirement savings essentially from scratch, even though she's been working her whole adult life. Sarah's situation is a good example of the middle ground, because her real life doesn't fit neatly into all aggressive or all safe. She's got about 22 years until 65, steady income from her job, but less margin for error than someone with a paid-off house and a partner's income backing them up. Sarah goes with a portfolio that's around 80% stocks and 20% bonds, aggressive but not maximum aggressive. Historically, that kind of blend has landed somewhere around 8% a year. On $15,000 saved and $600 a month, that grows to roughly $480,000 by 65. If Sarah had gone fully conservative instead, that same $15,000 and $600 a month at 4% grows to about $270,000. That's a $210,000 difference, and Sarah didn't have to take on maximum risk to get most of the benefit. This is the part that gets lost in the all-or-nothing framing. You don't have to choose between all stocks and all bonds. There's a wide middle, where you capture most of the growth without taking on the full volatility. There's also something Sarah's situation exposes that pure math doesn't capture: the emotional side of risk. Sarah rebuilt her savings after a divorce split her finances in half. For her, watching an account swing wildly isn't just an abstract number. It's tied to a period where money already felt unstable. If going 100% aggressive means Sarah checks her account every week in a panic and eventually bails during a downturn, then on paper, 100% stocks might be the better choice, but in practice, it's the worse one, because the version of the plan that actually gets followed beats the version that looks better on a spreadsheet but gets abandoned in a crash. This is why Sarah's 80-20 split matters. It's aggressive enough to capture most of the growth and stable enough that she can actually stick with it for 20 years without flinching. Now let's talk about David, because David's situation is exactly where the aggressive is always better argument breaks down, and it's important we don't oversimplify this. David is 50. He's got a shorter runway, call it 15 years instead of 25, and David's biggest threat isn't slow growth. It's something called sequence of returns risk. Here's what that means in plain terms. If David is 100% in stocks and the market drops 30% the year before he retires, or worse, in the first few years after he retires while he's withdrawing money, that crash does far more damage than the same crash would have done at age 40. Because at 50, there's less time to recover before he needs the money. And once you start withdrawing during a downturn, you're selling more shares to generate the same income, which locks in losses instead of riding them out. This is the real legitimate reason SAFE exists as a strategy. But here's the key detail people get wrong. It's not that David should have played it safe his whole life. It's that David should be shifting towards safer investments as he gets closer to needing the money, not starting safe at 40 and staying there for 25 years. This is sometimes called a glide path, and target date retirement funds are built around exactly this idea: aggressive when retirement is far away, gradually more conservative as it approaches. If you're 40 right now, you are, statistically, at the point on that glide path where aggressive makes the most sense, not the least. Let's put David's specific numbers on the table too, because shorter runways shouldn't just be a phrase, it should be a figure. David has $60,000 saved at 50 and contributes $900 a month for 15 years. If David stays aggressive that entire stretch, no shift towards safety at all, and gets a bumpy sequence of returns where a downturn hits in his final 2 years before 65, a rough historical scenario shows his ending balance could land anywhere in a wide range, sometimes several $100,000 lower than the smooth average projection would suggest, purely because of when the bad year happened to fall. That range, that uncertainty right at the finish line, is what David is paying to avoid by shifting a portion into bonds as he closes in on 65. He gives up some upside in exchange for a narrower, more predictable range of outcomes, exactly when predictability matters most. So let's bring in Linda for a moment, because Linda's case shows what happens when someone does shift at the right time instead of guessing. Linda started aggressive in her early 40s, similar to Marcus's second scenario, and stayed heavily in stocks through her 40s and most of her 50s. Around age 58, with retirement 7 years out, Linda started gradually moving a portion of her portfolio into bonds and more stable holdings, a little each year. By the time she reached 65, roughly 55% of her portfolio was in stocks and 45% in more conservative holdings. Enough growth to keep compounding, enough stability that a bad year right at retirement wouldn't wreck her plan. Linda didn't have to choose aggressive forever or safe forever. She got the growth years when growth mattered most, and she got the protection right when protection mattered most. That's the actual answer to the question in this video's title, and it's more useful than picking a single winner. Let's zoom out and put real numbers on the two extremes, because proof beats opinion every time. A 40-year-old with $30,000 saved, contributing $700 a month for 25 years. At 4% average annual return, the cautious, all-safe path, that grows to approximately $410,000 by 65. At 9% average annual return, the aggressive, mostly stocks path, that same contribution schedule grows to approximately $780,000 by 65. That's a difference of roughly $370,000, generated by nothing except which boxes were checked in the account settings. Same person, same sacrifice, same monthly discipline. Now, if you're thinking, but averages hide the bad years, you're right. And here's the honest answer to that. Yes, an aggressive portfolio will have years where it drops 20, even 30%. That's not a risk you're avoiding by going aggressive. It's a trade you're accepting in exchange for a dramatically higher long-term average. And at 40, with 25 years before you touch the money, history shows that trade has paid off in essentially every extended period on record. The danger isn't the drop. The danger is panicking and selling during the drop, which turns a temporary paper loss into a permanent real one. So how do you actually put this into practice without a finance degree and without staring at your account every day? For most people in their 40s with 2 decades or more until retirement, a reasonable starting point looks like this. Somewhere between 80 and 100% in stock index funds, a total market fund, or a combination of a large company fund and a smaller supporting fund, and the remainder, if any, in bonds. That's it. That's the core of it. You don't need 11 different funds and a spreadsheet of ticker symbols. You need broad ownership of the market and enough time to let it work. The second piece is a plan for when that mix should start changing. A common approach is to leave the allocation alone until roughly 10 to 15 years before your target retirement age, and then shift a few percentage points from stocks into bonds each year after that. Not all at once, not in a panic, just a steady, boring, pre-decided glide. If that sounds like too much to manage manually, this is exactly what target date retirement funds are built to automate. You pick the fund with a year close to when you plan to retire, and the fund quietly handles the shift for you in the background. The third piece, and honestly the most important one, is deciding in advance how you'll react to a crash, before the crash happens. Write it down if you have to. Something as simple as, I will not check my balance more than once a month during a downturn, and I will not sell. Because the math we walk through today only holds up if the strategy survives contact with an actual bad year. The portfolio doesn't fail people. Fear does. So here's the actual practical answer. Not a hedge, not a it depends cop-out. If you're 40 and retirement is roughly 20 to 25 years away, the evidence points toward being aggressive now, heavily weighted towards stocks, and gradually becoming more conservative, starting somewhere in your mid to late 50s. Not because safe is wrong forever, because safe is wrong right now and right later. The mistake isn't choosing the wrong side of aggressive versus safe. The mistake is treating it as a single, permanent decision instead of a strategy that evolves as your timeline shrinks. Marcus, Sarah, David, and Linda didn't win or lose because they picked a label. They won or lost, or are still in the process of winning, based on whether their strategy matched how many years they actually had left before they needed the money. If you take one thing from this video, take this. At 40, sitting in cash or bonds because it feels safer isn't protecting your future. It's quietly taxing it to the tune of hundreds of thousands of dollars in exchange for a feeling of comfort you don't actually need yet. So the real question was never aggressive or safe. It was how much time do you actually have, and does your portfolio know it? Once you answer that, the rest is just arithmetic. And that arithmetic is exactly where we're headed next. Because once you know how your money should be allocated, the next question is how much of it you actually need in the first place. That's what we're breaking down in the next video. The real net worth math if you're starting from zero at 40.